Make your next move with American Express Business Platinum. Earn 5 times membership rewards points on flights and prepaid hotels booked on AmexTravel.com. And with a welcome offer of 150,000 points after you spend $20,000 on purchases on the card within your first 3 months of membership, your business can soar to new heights. Terms apply. Learn more at americanexpress.com/business-platinum. Amex Business Platinum. Built for business by American Express.
Every cup of Nespresso coffee is an invitation to transform your morning routine into a ritual you can treasure each and every day. Using the Virtuo Pup, a simple touch of the button freshly brews bold aromas and a rich, velvety crema layer for delicious cafe-quality coffee at home. Whether you enjoy your coffee hot or over ice, every sip, every morning is unforgettable. Nothing tastes like Nespresso coffee. Visit Nespresso.com or our app to explore our full range of easy-to-use machines and coffees not found anywhere else.
Welcome back to The Bull, your personal finance podcast. And we have hit 200. Before saying anything else, thank you, and once again thank you to the hundreds of thousands of listeners who have followed me on this long journey through finance, economics, and life itself. Writing and talking about finance is one of my greatest passions, but none of this would be the same without each and every one of you. You have challenged me to reflect, rethink, and reassess my beliefs, to question my assumptions, and in doing so, we have all grown together, hand in hand, along the way. And today marks the start of a new chapter in this journey. I couldn't have asked for a better guest to kick off the next 100 episodes of our adventure than one of my personal heroes, Ben Carlson. For over a decade, Ben has been writing and speaking about finance with unwavering dedication, distilling fundamental concepts with remarkable simplicity to help people manage their savings and investments in the best possible way. Much of what I know and share with you has been influenced by Ben, so it should come as no surprise that I was eager to have him here to celebrate this symbolic milestone for our podcast. Without further ado, here's my conversation with the great Ben Carlson. Enjoy it! Dear Ben, welcome to episode 200 of The Bull.
Glad to be here.
It's great to have you here. You have an amazing blog, an amazing channel, the Animal Spirits podcast with Michael Batnick, and I can even realize how much content you can deliver every week. How can you do so much work while doing your full-time job as Director of Institutional Asset Management at Rethouls?
I really enjoy, I think that's part of it, is I really love the markets and love thinking about everything that goes into them, not just from the numbers and stuff, but the psychology behind it and what the feelings people get from making money decisions and how the ups and downs of the market and the volatility, how that brings out the best and sometimes the worst in people. And so I've always just found that writing helps me learn what it is that I really think. So I have all these jumbled thoughts up here, and getting them down and jotting them down helps me understand what I think. So selfishly, I find the writing process is kind of cathartic for me, and it helps me understand what's going on in the world.
Yeah, I agree that you really understand something when you start teaching it.
Yeah.
Because if you read it, you can understand something, but if you teach it, you have to figure out all the stuff.
Yeah, and I get tons of feedback from the people who are reading too, and questions, and say, hey, haven't you thought of this? And so it's really cool to have the interaction with people as well that kind of help me figure out what,
Why do you think that finance is mostly a matter of common sense? Your newsletter is named A Wealth of Common Sense, of course.
My whole thought, I came up in the institutional world, which is these big pension funds and endowments and foundations and nonprofits, and they were managing billions and billions of dollars.
I imagine.
And And I couldn't figure out, especially I lived through early on in my career the great financial crisis in 2008. And
Wow.
I couldn't figure out why all these huge pools of capital all had such complex portfolios, because it made managing money through that process and that downturn so much more difficult. It was just operational heavy lifting. It was a lot of paperwork, and a lot of the people, the boards and committees didn't really understand what these people were investing in on their behalf, right? And so I just realized a simpler approach is just more effective. The problem is, for really smart people who went to like really good colleges and they have their CFAs, or they are working in hedge funds or whatever, it's hard for them to do a simple approach because they think that advice has to be complicated or complex to be good, right?
Sure.
It has to sound really smart, and it's got to be like a black box. And I realized that for individuals, it doesn't have to be like this. Like there's career risk for those people who manage these millions and hundreds of millions or billions of dollars, but regular people almost have the advantage over them because they don't have to impress anyone,
totally,
right? There's no like award for doing things harder, like degree of difficulty in gymnastics. That doesn't work in the investing world. And I just find that advice doesn't have to be complicated to be good. Like I have a friend who is a doctor, and he said, listen, the two biggest things that have brought us forward health-wise are penicillin and then just doctors washing their hands, right?
True.
It's like simple things like that can just, that's, it's the big things.
I believe that we are kind of wired to think that things must be complicated to be right. I remember that you once said that the worst investors are typically doctors or engineers because they have to overcomplicate things, because in their job they typically do complex stuff. The simplicity of passive investing is something weird to accept in the first place.
Yeah, no offense to any doctors or lawyers or engineers out there, but
it was just a joke.
But what I found is that sometimes the smarter you are, the harder it can be to simplify when investing, because you think, listen, I went to school for all these years and I studied and I'm brilliant, and so that brilliance and intelligence is going to translate into the markets as well. And the markets don't work like that. It's not a lot of areas in life. I tell my kids, if you work hard at school, you can get better and improve your grades, right? If you go to the gym or you work on your sports, you practice a lot, you can improve yourself.
Totally.
The markets don't always work like that. If you try harder in the markets and do more and trade more and try to outsmart people, that can often be to your detriment, and it doesn't always guarantee better results. And so a lot of the times the people who try the hardest and do the most stuff and always are constantly changing things, they end up doing the worst of anyone.
One of the typical situations in which people try harder, as you mentioned, is when they try to time the market. Like in this particular time when people started to freak out because the S&P 500 dropped 10% or so. You helped me figure out a lot of stuff about finance and investing, and among them, there's the idea that if you want to time the market, it's highly delusional because you have to be right twice. Could you explain what you mean?
Yeah, and I really started to bump up against this with clients in like 2015, 2016. We talked to people who say, I got out of the market in 2008. I saved myself a lot of heartache. But the problem was I could never psychologically get myself to get back in, right? So even if they got out, I talked to someone who got out of the market like the Friday before Lehman Brothers went under in September of 2008.
Great timing.
Like, great timing, right? Because the market was straight down there for the next 5 or 6 months, down like 40% from there. But they couldn't, the cash at that point became so comforting, and it felt like, well, what if the market falls even further from here? And what if this is just a dead cat bounce when it starts coming back? And then they never got in, and then 8 or 10 years later, they're still sitting in cash and they're paralyzed, and they go, now what do I do? If I get in now, what if the market falls over again? And so that's the hard part with market timing. And what I always like to tell people is that when you look at the historical return of the stock market, so over the last 100 years, the U.S. stock market is up 10% per year, roughly, right? Give or take. That's not just, I invested on the good days, but I sidestepped the bad days, right? That includes the Great Depression and the 1987 crash and the 2020 crash and the Great Financial Crisis and all these bad things. That's all baked into the pie, right? All that bad stuff that's happened. So I've never met anyone who has the ability to consistently sidestep the market and then get back in when the dust clears. And the hard part is that the market doesn't usually bottom on like better news. There's not a headline that says, "Hey, news is great again. The economy's doing wonderful." It's better or worse. It's like the news just becomes less bad. It's still bad, right? When things were happening in COVID and the stock market crashed 35%, there were still millions of people losing their jobs, and there was still hundreds of thousands of people getting sick and people dying. But the news was getting better, and by the time we got the vaccine, the market was already back at all-time highs, right? The market didn't wait around for the good news headlines to hit. It moved ahead of them, in advance of them.
It seems very easy in hindsight that you can time when the market is going to go down and when you should come back in. But the really hard stuff is to cope with your emotions when this happens. I remember during COVID that it made no sense that in May or so the market was recovering with all the world still shut down.
Yeah, and sometimes the stock market in the short term doesn't feel like it makes a whole lot of sense because there's a lot of times over the long run, the stock market, generally, if the economy is doing well, the stock market's going to do well. But there are times in the short term where it can feel really, really backwards. And the same thing happened in the 2008 crisis. The unemployment rate for the United States didn't top out at 10% until like October of that year. By that point, the stock market was already up 60 or 70%. So it didn't wait for the economic news to start improving. It moved ahead of it, and that's the hard part. And the other thing is, when the stock market goes down, people always wonder, well, is this going to be the next recession? And there's the old joke that the stock market has predicted 9 of the last 5 recessions, right? Because sometimes the stock market goes down and the economy is still doing fine. And that's the head games that it plays with you, that the stock market is far more volatile than the fundamentals would dictate.
People are often concerned with the idea of missing the right time to enter the market, or worse, to invest at the very worst time, maybe just right before a crash. You published a very fun cartoon about Bob, who's the world's worst market timer. Could you please tell us the story about Bob, this fictional character you made up?
Yeah, so I first wrote about this back in 2014, and the worry was people were saying, well, the market had made up all the losses from the 2008 crash, but now we're at all-time highs, and those are scary, right? The last time we were at all-time highs, the market crashed. So what if I'm doing that again? Which is kind of funny to think about now, because 2014 was so long ago, and the market still did fine from there. But I wrote this piece, and the funny thing is that for probably 8 years, every year it was by far the most popular blog post I've ever written. 1 million people have read it. It still gets hundreds of thousands of views every year. For some reason, that message really resonated. And I just said, what if you went back at history's worst times and bought right at the peak, and then the stock market crashed, but you didn't sell out of your shares, right? So I got this hypothetical guy, Bob, and I said, what if he just kept his money in the bank account because he's so nervous all the time, and then he puts his money in when he's ready to invest again? And he did it in 1980, right before a recession. The stock market fell almost 30%. And in 1987, we had the worst one-day crash in history. Stocks fell 20% in a day. They fell almost 35% in a week. And then in 1999, right before the dot-com bubble blew up and the stock market got cut in half. And then 8 years later, for the great financial crisis, you bought in the fall of 2007, the stock market falls almost 60%. So those 4 times, he put his money in, but he didn't take any of it out. And he basically, I think it was like he 6 times his money. He ended up being a millionaire, even though he put like $100,000 in. And the point was that if you extend your time horizon and just, even really, really big mistakes and mistimed investments can be good. It's selling out that is often the biggest problem for people, not when they get in. And I also looked at, well, what if Bob would have just dollar cost averaged, right? He just put his money in once a month. He obviously did way better. And that's a much easier and gives you less brain damage along the way, right?
Sure. I also feel that the media contributes to the feeling that you must do something with your investments when the environment changes. When he was here, Gene Fama told me that the media is entertainment, basically. You must not read the media in order to make sound investment decisions. It was cool that in one of your latest pieces last Saturday, if I remember well, you cited an article from the Wall Street Journal about the death of the buy and hold strategy. And I made kind of fun of this very same article in one of my most recent episodes. The article idea was that it's now time to move from this framework from buy and hold because of tariffs, because of what's going on under Trump and so on and so forth. And it seems crazy to me because we're just 3 months into 2025 and this is just a little shift in the market. You shouldn't even think about changing your asset allocation and stuff like that because of what's happening. Why do people think that they must do something when times becomes more uncertain? Times are always uncertain.
Yes. And I think that there are certain investors, this is obviously not everyone, but there's certain investors that when the stock market goes down, they get too defensive right after the stock market has already rolled over. They should decide to discard their investment plan with their asset allocation, and they say buy and hold is dead. And to my earlier point, buy and hold never really dies. You get the good with the bad. And I think the real reason people do this is because they want to feel like they have their hands on the steering wheel and that they're driving, right? And this is why people pay way more attention to the financial media when the stock market is going down. When the stock market is going up, sure, it makes people feel good. Yeah, no one cares. They don't pay attention. And the thing is, when the stock market goes up, there's this old saying that the stock market takes the stairs up, but the elevator down. Like it goes down in a hurry, but the elevator also goes from like floor 3 up to 10, back down to 1, and it goes really quickly. And you have all this volatility, and that's what makes people panic. Is just seeing their life savings incinerated really quickly makes them panic, and they want to feel like they have their hands on the steering wheel. But I tell people that it's an illusion of control, right? Just because you're paying more attention and you're looking at your portfolio more and you're trying to do more, that doesn't necessarily mean you're going to sort of outsmart the market just because it's falling. And I like to tell people, you're better off having an asset allocation in place that you're willing to hold during up markets, during down markets, during sideways markets, instead of trying to pick and choose, well, I'm going to hold more stocks now because things look good, or I'm going to hold less stocks now because things feel bad. That's a recipe for disaster because you're driving in the rearview mirror, investing how you wish you would have invested before this event even happened.
Yeah. There is an overwhelming amount of research proving that it's very hard to time the market and make sound decisions ahead of time. And so for most of the people, they would be better off sticking to their portfolio without much further ado. With my podcast, I try to give simple advice about long-term asset allocation frameworks. And as I told you before we met, I suggest a simple formula to size your stock allocation, which is 125 minus your age minus a coefficient I came up with that takes into account the interest rates. So risk-free rate times 5 or Fed funds rate times 5. The whole idea is to overweight stocks when the interest rates are very low, like in 2021, in order to avoid what happened in 2022 with bonds going underwater. And the other way around, to underweight stocks when interest rates are high, because historically it makes sense. Do you use any framework to help people set their asset allocation?
I like your idea of having a simple baseline and then going from that baseline, figuring out what works for you. So, for example, young people in their 20s or even early 30s, their biggest asset by far is not financial assets. It's time and future savings, right? It's human capital. So if you have decades ahead of you to ride out bear markets and to deploy your future savings, as a young person, you should get on your hands and knees and pray for bear markets and crashes, right? Because you can buy at lower prices. So I think at that age, you have the ability to take as much risk as you want, meaning 100% in equities for your retirement assets. But some people don't have the emotional makeup to handle that. And I think it's important to recognize that. So I always like to say that the way you set your asset allocation and your risk profile is 3 things: your willingness, need, and ability to take risk. So your need to take risk is just what return do I need to reach my financial goals in the future, right? Your ability to take risk is just kind of what are your current financial circumstances? How much money do you make? What is your savings rate? What do you think your earnings power is going to be in the future? And then your willingness to take risk. I think this is the most important one for people. That's just like, how much risk are you comfortable taking? How much risk is too much where you can't sleep at night? And this is the hard part because you can't quantify that, right? It's based on your personality, your emotional makeup, and then your experience. And I always like to tell people, the best predictor of future behavior is past behavior. So in 2020, did you sell out of the market, right? And get out and say no. In 2008, did you sell out of the market? In 2022, did you get out of the market? Or did you have a steady hand and hold through it? I think that's one of the ways that you can figure this out. So I do like your formula as a baseline, and then I think you have to kind of make tweaks here and there for your own personal emotional makeup and personality and circumstances and go, I have a volatile job, so I don't want to take a lot of risk because if I lose my job and my income, I'm going to need to rely on my portfolio. Or I'm in a government job. I'm set for the next 4 decades. I can take all sorts of risk and I don't have to worry about it. So I think a lot of it has to do with that personal circumstance side of things. But I do think where you are in your life cycle, are you young? Are you middle-aged? Are you old? That should be sort of the baseline, right? Because when you're older and you're retired, you don't have future income. You don't have as much time to ride out bear markets. You need to have more of a balanced portfolio to make up for your current spending needs.
Yeah, the idea of a risk aversion coefficient, like in the famous Merton share from Bob Merton, who uses the idea of adjusting your asset allocation according to the risk you are willing to take. It's great in theory, very hard in practice, because you typically figure out how much risk you are willing to take during your first bear market, which is typically a very bad place to know who you are.
Yeah, and I do think, though, that making mistakes when you're young, that's the time you want to make them. Hopefully you learn from others but that came before you and don't make those same mistakes. But if you make mistakes, make them when you're young, when the money is much lower, right? And the percentage loss is not going to harm you as much. And then when you're older, hopefully you figure out and find something that actually works for you that you can stick with. I always say that, like, perfect is the enemy of good for investors. That, like, the perfect strategy that you can't stick with is kind of useless. It's almost the same thing as failure, because if you can't stick with something and stick with it hell or high water, it's not going to be very useful to you. The good strategy you can stick with is far superior to the perfect strategy that you can't stick with.
Sure. You're a great fan of index funds, ETFs, and low-cost instruments for investing that basically track broad indexes, and I am too, obviously. Are you concerned that indexing can bring about distortions in the market, like inefficiency, higher volatility, some kind of financial Armageddon? What do you think about it?
I do think it's kind of funny to think that it's a bad thing that millions of investors are paying lower fees in a more tax-efficient product and outperforming the vast majority of professional investors on Wall Street. That sounds like a great thing to me. I understand where the worries are about market structure. Like, could this lead to more flash crashes or something like that? But I just find it hard to worry about index funds when we have things like levered ETFs and meme stocks and meme coins and zero-day options. I think there's a lot of other things that I would worry about well before index funds. And I think index funds have, been one of the great contributions to investors of the past 50 to 100 years, for sure.
Yeah, definitely. Beyond the very basic advice to just hold the market in a market cap weighted fashion, as long as we talk about stocks. Starting from 1992, Famin French invented the 3-factor model and the idea to overweight, for example, value stocks and small cap stocks, and other factors came along later in the upcoming years. Given that stock picking is rarely a successful strategy, at least for the retail investor, do you think that systematically overweighting some kind of stocks or some kind of factors could be a winning strategy for a buy and hold portfolio?
The way that I look at it is I don't look at these other strategies, whether it's value or high quality or high dividends. So there's a lot of different factor strategies, momentum. I've never looked at those strategies as like a way to find alpha, right? I'm going to outperform the market by investing in small cap value stocks or momentum stocks or whatever it is. I look at those as a form of diversification. And I think any strategy that there is can go through long periods of underperformance. Warren Buffett at Berkshire Hathaway has had plenty of periods of underperformance where he he didn't keep up with the market. The S&P 500 had a lost decade from 2000 to 2009, right? And what really helped you there was diversifying into foreign stocks or value stocks or high quality or dividend. And I think that's the benefit of these types of strategies. I do like to have strategy or diversification not only by asset allocation, so stocks, bonds, cash, and whatever other investments, but also by strategy. And so that could be different size market caps, right? Small, mid, and large caps, or international stocks, or value stocks, or momentum stocks, or whatever it is. I think having those different strategies can allow you to have a more well-balanced portfolio when one piece of the portfolio isn't working. Now, the other side of that is, unfortunately, there's always going to be something in your portfolio that is going to be lagging. And you're going to go, what am I doing investing in this? So I think that diversification, to use a baseball analogy, is you take away the home run because you're not always going to be invested in the best performing asset class or strategy. But you also take strikeouts out of the way, right? You're never always going to be fully into the worst strategy. And that's the way I think about a more balanced, diversified approach.
Yeah, that's a great point, which is an asset for me for the next question. Because as far as I know, you have always suggested international diversification, although in the last 15 years, investing in something other than the S&P 500 has meant underperforming your neighbor's portfolio. Now, since January, people have started to think, the American exceptionalism has come to an end, and now Europe and China will be the next decade winners, and so on and so forth. We obviously tend to draw conclusions too fast and too far into the foreseeable future. But let aside specific market environments, what's the timeless case for international diversification in your opinion?
Yeah, I just think that trying to predict who the winners in the future are going to be is really difficult. In the 1980s, people thought Japan was going to be the largest economy in the world.
Sure.
They got up to like 45% of the global stock market back in 1989.
Crazy.
It was very high, and now they're down to 6% or something. And if you would have put all of your money into Japan in 1989, over the next 3 decades, you made no money, and you went through a huge crash, and you basically went nowhere. You didn't get made whole until like 2023, I think, where Japanese stocks finally hit all-time highs again. But if you invested around the world, and even including Japan in like a global stock market index, you still did just fine in that period. Even though Japan was awful, one of the largest developed countries in economies and stock markets, all these other countries made up for it. And I think that's the thing where with the U.S., where I think if you had kept all your money in U.S. stocks over the long term, you'd probably end up doing just fine. But I think you just don't want to find yourself in one of those periods where you have a lost decade and things don't go so well right when you need the money and you need to spend it. And that's my case for international diversification, is that you just don't know where the next winners are going to come from or the next losers.
Yeah. We all know that the S&P 500 delivered 10% a year, the MSCI World 8 to 9% a year in the last half a century. Nevertheless, it's difficult to stick with a 100% stocks portfolio. But the typical objection is, if in the long run stocks are the best performing asset, why should I bother investing my money in bonds that yield less than stocks and can even be more volatile when inflation and interest rates spike?
I think there's a few reasons that you invest in bonds. One of them is that it provides dry powder in the event that the stock market falls, right? So if the stock market falls and you want to be a buyer when stocks are down, that money has to come from somewhere. And it could come from savings, it could come from cash, but I think bonds tend to be a really good place, even though that wasn't the case in 2022. Most of the time when the stock market is down, the bond market does extremely well. I also think that bonds can act as the shock absorber for spending. Like, one of the things, if you're using your portfolio for spending purposes in retirement, you don't want to be forced to sell stocks when they're down, right? That's locking in losses. You want to be able to wait for them to come back. And bonds are a way to do that, where if the stock market is up, maybe you take from your stock market withdrawals and spend that way. When the stock market is down, that's when you have bonds as the counterbalance and you take from your fixed income for spending purposes. And then the third reason is just an emotional hedge. Again, some people cannot do the one, even if they should, based on their age and their time horizon. There's circumstances they should be able to take a 100% equity portfolio. Some people simply cannot do that. They're not going to be happy. They're not going to sleep at night, and they need bonds as more of an emotional sort of volatility hedge to dampen the volatility in their portfolio. So those are the reasons that bonds make sense for some investors.
I think I've read some thousands of pages from papers and reports and articles in the last couple of years by people claiming that in the future it's highly unlikely that the stock market will deliver this high premium that it paid in the past. Because for the 40 years or so following 1981, interest rates went down in a straight line while valuations grew a lot. So a reversion of the mean is likely, and it's going to be difficult to have such a huge run for the next half a century. Do you think that the risk premium for investing in stocks will be lower in the future?
That's possible. It is funny. I looked at the numbers like pre-1980, and the returns have been higher since 1980, but it's not that much higher. You still got like 10% per year before 1980, and it's been more like 11 or 12% since then. So returns have been higher as rates come down, but it's not like there was no returns before interest rates got high and then fell. So that's not the only reason. I do think the case that valuations are higher and interest rates are lower would make sense, where returns should be lower going forward. My one takeaway is that in the past, investors were paying much higher costs. So even though gross returns were higher, their net returns were probably about the same. So they were paying, there was no tax-deferred investment vehicles to invest in. There were no ETFs or index funds that allowed you to buy the market with minimal cost. You're paying cents on the dollar, right? Tiny cents. And so in the trading was much harder. Like commissions were higher. The bid-ask spreads were higher. So the fact that markets are more efficient now and you pay lower costs, I think as long as you're able to buy and hold and behave, I think your net returns are probably about what they were for people in the past. It's just their gross returns may have been higher because it was harder to access the market because fees were so much higher.
Yeah, sure. Do you think people's perception of risk has decreased compared to the past, making them maybe more willing to accept a lower rate of return?
Yeah, I think that makes sense. And I also think the fact that we have the Federal Reserve to step in as a lender of last resort, like one of the reasons that we got the Great Depression, in the Great Depression, the stock market fell 85%. And part of the reason for that was the economy was falling off a cliff, obviously, but the Fed was tightening monetary policy, and then the federal government was pulling back on spending. And so now you have a situation where we've learned from that, and now the government is coming in and they're spending money when there's a recession, and the Fed is lowering rates, and they're trying to prop things up. And so I think if you take away that sort of left tail event like the Great Depression, it would make sense that your risk premium maybe goes down a little bit because you had to be compensated with a higher return to invest in stocks when they're that risky, right? But I do think there's something to say for the efficiency in the way that we can access now. Like index funds didn't exist back then, right? ETFs didn't exist. $0 trades didn't exist. So I think as long as you're able to keep a calm head, I think you're still going to be pretty good. And even if the risk premium is lower now than it was in the past, I think stocks are still your best bet for beating inflation and beating fixed income.
Yeah. The typical portfolio's backbone is made by stocks and bonds for decades. But now there's a lot of discussion around the idea of including other diversifiers because the correlation between stocks and bonds is higher, at least in the last couple of years. And maybe you need something else in order to have a well-diversified portfolio than in the past. What do you think about investing in assets like gold, commodities, or private markets, and so on and so forth?
I think that is actually like the double-edged sword of the world we live in, is that it's never been a better time to be an individual investor in terms of the strategies and asset classes and investments that you have available to you. Like investors of the past wouldn't believe the types of strategies you can invest in, again, for like a handful of basis points. In the past, some of these strategies were only available to institutions or hedge fund investors. And so I think that is a wonderful thing for individual investors, that you have this wide array of choices. On the other hand, you're constantly tempted to, well, what if I put a little bit in this? What if I put a little bit in that? Wait, now if I move. So I do think it's more important than ever to kind of define the stuff that you won't invest in, right? Like this stuff is available and maybe it's a good investment for someone, but it's not going to be for me and my portfolio. So I do think that it's more important than ever to really define what it is you will and won't invest. And I think you also have to figure, like, is this going to move the needle? If I put 2% of my portfolio in gold, is that really going to do anything for me, right? I think you have to figure out a point where it makes sense, where it's actually going to make an impact and not just add another fund or another layer of something to your portfolio and make it more complex. So I do think you need to be smart about the stuff that you're willing to allow into your portfolio, to not let things get completely out of hand.
Yeah. When Ed Giardini came here, he told us that on his headstone, he wants a quote saying, Ed Giardini, usually bullish, usually right. It was great. And you are optimistic too about the stock markets in general most of the time. And the question here would be about you being a permabull. But I'd love if you would comment on an incredible quote you put out recently, which is, the big long wouldn't sell nearly as many copies as the Big Short, but its readers would make far more money.
Yeah. I try to stay away from the whole idea of being bullish or bearish because I know that bad things can happen, right? Markets will correct, bad stuff can happen. So I wouldn't say that like I'm bullish all the time, because I think that if you're bullish all the time, that's
it's
not
naive.
Yeah, it's naive. Yeah, hope is not a strategy, you like to say. But I do think if you're a long-term investor and you're not optimistic about the future, what's the point of investing in the first place, right? The reason I invest is because I think people are going to wake up and get out of bed every day and try to better their station in life, right? They're going to try to make more money for their family and spend more money, and I think companies are going to continue to innovate, and they're going to continue to try to grow profits and grow sales, and that I think is one of the reasons you invest for the long term and have a glasses half full outlook on the world. I just think the stock market is such a wonderful place because it literally allows you to buy a piece of the best businesses on the planet and earn a piece of their profit. I think sometimes people forget that, and they think it's just trading these digits in the computers or numbers on a piece of paper or something. But you're literally buying the cash flows and profits and dividends and growth and ingenuity of these big, huge companies. And we have some of the best run companies in the world right now that you can own a piece of. And that's the coolest part about the stock market to me, is just that you have the ability to do that. And as long as they continue to want to earn profits and get bigger, you can earn your piece of them.
Yeah, sure. This allows me to ask you about another great quote from you. It was on Twitter or wherever his name is now. The quote is, your goal in life should be to try to find someone who loves you as much as Ray Dalio loves trying to predict the next financial crisis. Please comment on that because it's delicious.
So one of the reasons that I started my blog in the first place is that I noticed that coming out of the great financial crisis, it was really easy to fall into this doom loop of here's the next big one, it's going to crash. And I just thought that people were spending all of their time worrying about stuff that happens like 2% of the time, right? And people thought, well, we just lived through one of the worst financial crises since the Great Depression. It's going to happen again. And the whole point is that a lot of times those are once in a lifetime or once 2 or 3 every lifetime, right? It doesn't happen that often. That's the whole point. That's why they're so big and consequential. And I wasn't trying to pick on Dalio himself here, but a lot of people that sort of predicted the financial crisis the first time around have spent the last 15 years trying to do it again. And because they saw all the adulation and headlines and stuff that they could get from doing it the first time, and so they're constantly saying, we think it's going to be terrible and this is going to fall and this is going to crash. And again, I'm not naive. I know that markets can and will crash. I know there will be corrections. I know there will be recessions. But those things don't happen as often as things going well and the economy growing. The United States has had one recession in the past 15 years, and it's lasted 2 months. It was during COVID. That's it.
Up until now, yes. No predictions about the future. So I do think that too many investors can get caught up in the negativity. And the hard part is that the negativity sells way better than positivity, right? If you say, hey, the stock market is going to go up, people say, that's not a good prediction. The stock market goes up almost all the time. It's up 3 out of 4 years on average. And it's like, well, that's my point, right? It doesn't go down nearly as much as it goes up, even though it can go down. And so
I've always said if I was a Wall Street strategist, I would just predict a 20% gain every year, and I'd probably be right like every 2 out of every 4 years. But you get more attention from the financial media if you predict a calamity and a recession and a crash. And I just think far too many people have gotten successful and gotten publicity from being right once in a row about something, and then they're wrong for years and years afterwards.
Yeah. I remember a post in a Wealth of Common Sense in December or January, when typically the banks put out their forecast for the end year target for the S&P 500, and the forecasts are typically average, like 8%, 10%, 12%. And you said, hey, wait a moment. Most of the time, the stock market makes plus 20% or minus 10, 15%.
Yeah.
Why bother trying to guess at 10%, which is highly unlikely that it will happen?
Yeah, the long-term average rarely happens in a given year. It happens like 4 or 5% of the time. Most of the time, the stock market is up really big or it's down really big, right? It rarely comes right around the average, which is one of the things that makes investing in the stock market hard, right? If you could just bank on getting 8 to 10% per year in and year out, the stock market would have no risk, and then it wouldn't give you that return. And so it has to be all over the place. Otherwise, you wouldn't get that premium. And that's the hard part about it. But it's funny, yeah, you're right. The strategists always just guess 8 or 10%, and that never happens.
My guess is that they know it, but their clients want to hear something conservative and be assured that things are going to play out just fine.
Yeah.
We kind of invest because we want that average. We want that 10% a year or whatever it is, but actually we get the 1 plus 20% a year, then a bear market, and so on and so forth. Biologically, we're not made to bear this kind of volatility. So investing is something, I would say, counterintuitive if we consider how we are made. We want a steady path from here to there. From the point of view of our gut feelings, our money shouldn't be on that roller coaster. Although we know this can happen, we can't accept when it does happen.
So that was the genius of Bernie Madoff Ponzi scheme. He never said he never said I'm going to make you 40 or 50% per year. That's Charles Ponzi was offering like 40% over 3 months or something ridiculous. So Bernie Madoff was giving investors like 12% per year. But
every year,
and that's what people thought. Like, it's not like he's offering us like crazy. It's just consistency, and that's why people were lulled into it and fell for him, because it was like that's what they want, is just consistency, right? If you could get that and just turn your brain off and not have to think about it, life would be great. But it doesn't work like that. To your point, the last 3 years coming into this year were down 20% in 2022. Up 20% in 2023 and up 20% in 2024, right? We had these huge moves, and to your point, our brains we're not set to handle that, right? With the DNA that we're meant to run from trouble, not run into the burning building and buy stocks when they're on sale.
Great. What's the point of money?
Yeah, I wrote about this recently, and I think about this a lot because I work in the wealth management space, and I think far too many people in the finance world look at this stuff from the perspective of I want to beat the market, or I want to get alpha, or I want to get the best risk-adjusted returns, and they're not really thinking about their end client who they're investing this for. Like, what is the point of the money to them? And so for our wealth management firm, a big piece of what we do is financial planning, and it's kind of like, what are your goals? Like, what are you trying to get out of this? What are your desires? What would you like to use this money for? And a lot of people have a hard time spending their money, because after they've spent 30 or 40 years accumulating it all and saving, like, they're really good at that, putting it all together. But now it's like you have to turn around psychologically and turn that switch and go, oh wait, now I have to spend it. I don't want to. I'm going to hoard it, right? I want to just live off the interest and hold the principal forever. And we have to talk to these people that the point of, delaying gratification in the present is so you can have some gratification in the future and enjoy some of the money and spend it. And not, you have to do that within the context of a financial plan and make sure it makes sense and run the numbers. But one of the things we try to do is help people figure out ways to spend their money and actually enjoy it with their family or their friends or their spouse or whoever.
So buy that fucking boat if you want it.
Yeah, if you want to buy a boat or buy a convertible or whatever, and you have enough money to do it, I'm okay with this. I think there are a lot of personal finance people who say, like, you should just never spend money and enjoy yourself. I don't agree with that. Life is short, and you can't take it all with you. So at a certain point, it's okay to just enjoy yourself and spend some of the money.
Last question. What's going on in the US under the new administration? Part of the deal, or is something more serious going to happen?
I wish I could tell you I knew what was going on with the president's policies in his mind. It seems to change on a weekly basis, right? We're going to put tariffs on all of our trading partners, and then maybe we're going to walk them back and be more flexible. I think it's just going to be sort of a volatile thing, and I don't think this can last for 4 years where he's constantly doing this.
We hope so.
Yeah. But I also think that investors were probably, a little spoiled coming into the year that things have been going so well, and regardless of the reason, I think that's the hard part for investors, is to separate like the reason for the correction with the actual correction itself, right? And it's really hard to just say, like, I know the stock market is going to fall eventually, but then when you put a reason on it, that's what gets you really nervous and scared, right? Like, oh, it's falling because this president is doing these policies that I don't like, and so I think you have to try to, as much as you can, detach those political feelings from just the stock market does this from time to time, and it's going to happen, and that's the hard part. But the guess about what's going to happen next, your guess is good as mine. But I still, again, have faith in the stock market over the long term that it's going to do its job. And if we have these tariffs that hurt margins and hurt profits for companies, then it's probably not going to be good for the stock market. But I do have faith that these companies can adapt. We've lived through a lot this past 5 years already, right? We had COVID where we shut the economy off for a couple months and turned it back on, and nothing really broke too bad, right? We had 4-decade high inflation, and companies were able to ride out that storm, and now we have tariffs, and companies are having to deal with that. So we've thrown a lot at these companies, and I think they've shown that they can manage these situations pretty well. So I probably have more faith in the stock market than I have in our administration at the moment. But I'm going to continue to place my faith in the stock market that over the long term it's going to be just fine.
Is the stock market the ultimate guardrail?
It is. It's the judge and jury, and it doesn't care what your politics are. It doesn't care what you say or what you believe. The stock market is going to hold you accountable and do what it's going to do. And right or wrong, the stock market is kind of heartless, right? So again, it doesn't care about your feelings, and sometimes it can be counterintuitive. But that's kind of one of the beauties of it, that it's like this last institution that you can't force it to do what you want it to do. It's going to do what it does.
Ben, thank you so much for joining us. It was a great gift to have you here as our guest.
Great to come on. Thank you.
And that's all, folks. I hope you enjoyed this episode and that Ben's words left you with even a fraction of the excitement that they gave me after our conversation. A huge thanks once again to Ben for sharing his time and his immeasurable wisdom on this very special occasion to me, and to all of you for choosing to ride along with me as we embark on the next 100 episodes. As always, I invite you to hit follow and turn on notifications on Spotify, Apple Podcast, or wherever you listen, and to leave a 5-star review to support us and help us keep bringing you a wealth of common sense content, always new. But for this episode, that's truly all. I'll catch you next Wednesday for another session, right here, of course, on The Bull, your personal finance podcast.